You think your retirement plan is set and forget. But what if the tool everyone's calling revolutionary is actually just expensive hand-holding, dressed up as innovation? Managed accounts in defined contribution plans are spreading like wildfire, promising personalized portfolios and better outcomes. Yet, the question no one's asking loudly enough is whether 40 basis points in fees actually moves the needle or just moves your money into someone else's pocket. Here's what happened. Target date funds were supposed to be the autopilot solution, the set it and forget it answer to retirement anxiety. But then came managed accounts, swooping in with algorithms and personal touches, claiming they could do better by tailoring allocations to your specific situation, your income, your outside assets, your risk tolerance measured down to the decimal. Suddenly, the narrative shifted from diversification is enough to diversification without customization is leaving money on the table. And plan sponsors started listening because personalization sounds sophisticated. Fiduciaries love sophistication when it comes with research papers. The promise was intoxicating. Imagine a world where your 401k adjusts not just by age, but by your actual life, your debt load, your spouse's pension, your weird uncle's inheritance you're counting on. For do-it-yourself investors who are making terrible choices and ultra-conservative savers sitting in cash earning nothing, managed accounts genuinely helped, nudging them toward reasonable allocations and higher contribution rates. But here's the twist. When you dig into the studies backing these claims, you start noticing something uncomfortable. Is the benefit coming from better asset allocation or just from encouraging people to save more? Because if it's the latter, couldn't a really good education program with some behavioral nudges accomplish the same thing for a fraction of the cost? We're talking about fees around 40 basis points annually, which doesn't sound like much until you compound it over 30 years and realize that's tens of thousands of dollars per participant walking out the door. The industry keeps pointing to research showing improved outcomes, but Ronald Smith and other skeptics are asking the hard questions. What's the control group? What's the ROI? And are we comparing apples to apples or apples to expensive oranges wrapped in marketing brochure? Plan sponsors are fiduciaries, which means they're legally obligated to ensure every dollar spent benefits participants more than it costs them. Yet many are adopting managed accounts based on glossy presentations rather than rigorous analysis of whether their specific population actually needs this level of customization. Let's get historical for a second. Retirement plan innovation follows a predictable cycle where each new solution promises to fix the last one's flaws while introducing its own. We went from pensions to 401ks, from picking your own stocks to target date funds, and now from target date funds to managed accounts, each transition accompanied by consultants insisting this time is different and this time we finally cracked the code. The pattern is always the same. Initial excitement, rapid adoption, eventual realization that costs matter, and one-size-fits-all solutions dressed up as personalized aren't actually that personalized. I missed the early managed account hype myself, assuming target date funds were good enough, and maybe I was right, because the jury's still out on whether the added complexity justifies the added expense for the median participant. Here's the cycle in one sentence. Financial services innovate by adding layers of customization and charging for them until someone points out simpler alternatives work nearly as well for less money. The community of retirement plan advisors is split. Some swear managed accounts are transformative, while others think they're overpriced window dressing that mainly benefits the providers selling them. Predictions range from managed accounts eventually dominating the DC landscape to them becoming a niche solution for high-income participants with complex situations while everyone else sticks with cheaper target date funds. The big misconception is that personalization always equals better outcomes. But personalization is only valuable if it changes behavior or allocations in ways that materially improve results. For most participants, already in age-appropriate target date funds contributing a decent percentage of salary, switching to a managed account might tweak their equity bond mix by 5 percentage points and charge them double the fees for that privilege. The math doesn't lie. If your managed account costs 40 basis points and your target date fund costs 10, you need to generate 30 basis points of annual outperformance just to break even, and that's before accounting for the fact that higher fees compound negatively over decades. So what do you actually do with this information? If you're a plan sponsor, you perform real due diligence. Demand clear data on which participant segments benefit most. Compare projected outcomes to enhanced education programs with similar budgets. And don't adopt managed accounts just because your consultant mentions them or your competitor's plan has them. If you're a participant, you recognize that managed accounts might help if you're young and confused or old and way too conservative. But if you're already in a diversified target date fund and contributing regularly, the incremental benefit probably doesn't justify the incremental cost. The lesson from every retirement plan innovation is the same: simplicity, low costs, and consistent contributions beat complexity and active management most of the time for most people. The broader wisdom here is that financial services thrive on creating problems that their products solve. And sometimes those problems are real, while other times they're manufactured through clever marketing. Discipline means resisting the urge to constantly tinker with your allocation based on the latest tool or trend, because time in the market and reasonable diversification matter infinitely more than perfect personalization. Position size in this context means contribution rate. Maximizing what you put in matters more than optimizing how it's allocated within reasonable bounds. Yet the industry would rather sell you expensive optimization than remind you to save an extra 2% of your salary. Process over conviction means plan sponsors shouldn't adopt managed accounts because they sound good or because a slick presentation convinced them. They should adopt them only after rigorous analysis proves they'll improve outcomes relative to cost for their specific population. Patience means recognizing that retirement investing is a marathon where small fee differences compound into huge outcome differences. So rushing into the newest solution without evidence is exactly backwards. The irony is that managed accounts market themselves as personalized and sophisticated, yet for many participants, the most sophisticated move is ignoring them entirely and sticking with simple, cheap, diversified funds. Philosophically, this comes down to understanding that retirement security is built on unglamorous fundamentals. Save early, save consistently, diversify broadly, minimize costs, and don't panic during downturns. Managed accounts might help some people, particularly those who would otherwise make terrible choices, but they're not a magic bullet, and they certainly don't change the underlying math of compound interest and fee drag. The honest conversation we're not having enough is whether plan sponsors are adopting these tools because they genuinely believe they'll help participants or because offering them provides liability protection and makes the sponsor look proactive. I'm comfortable with however this shakes out because the principles don't change. If managed accounts prove their value through rigorous, transparent research showing meaningful ROI for broad participant populations, they'll earn their place and the fees will be justified. If they don't, plan sponsors will eventually realize they're paying premium prices for marginal benefits, and the pendulum will swing back towards simpler, cheaper solutions. Either way, the participants who succeed will be the ones who maximize contributions, minimize costs, stay diversified, and ignore the noise around whatever product the industry is hyping this year. The real scandal isn't that managed accounts exist, it's that we're having this debate at all, instead of focusing on the elephant in the room, which is that most Americans aren't saving nearly enough regardless of how their meager savings are allocated. We're arguing about 40 basis points, while millions of people have 0 basis points because they have 0 retirement savings. And maybe if the industry spent less energy inventing new fee layers and more energy on increasing participation and contribution rates, we'd actually move the needle on retirement security. But that's a less profitable conversation. So here we are, debating whether personalized algorithms justify double the fees while the median retirement account balance remains tragically low. The contradiction is beautiful in a perverse way. We have more sophisticated retirement tools than ever before, more data, more customization, more options, yet retirement outcomes aren't dramatically improving. Because the problem was never about allocation precision. It was always about savings rates and behavioral consistency. You can have the most perfectly optimized managed account in the world, but if you're only contributing 3% of your salary and panicking out during every market dip, you're still going to retire broke. The hidden truth is that education, behavioral nudges, automatic enrollment, automatic escalation, and employer matches probably do more for retirement security than any allocation strategy. Yet those unsexy interventions don't generate recurring fee revenue, so they get less attention than they deserve. Here's your action plan. If you're choosing between contributing more to a simple target date fund or contributing the same amount to an expensive managed account, choose the former every single time because the math is undefeated. If you're a plan sponsor, demand proof, not marketing materials, but actual, rigorous, third-party, validated research showing your participants will be meaningfully better off in managed accounts than in enhanced education programs or better designed target date fund lineups. And remember that sometimes the best move is the boring move, the cheap move, the move that doesn't require a consultant or a flashy pitch deck. Because compound interest doesn't care about innovation, it only cares about time, contributions, and fees. Whether you're navigating retirement planning, real estate investing, home contracting work, or finding the right lenders to make your financial goals reality, we can help you get started. Check out our links in the description below.